As Powell was delivering his prepared remarks at the press conference, but before he went off script and took any questions, he read something that scared the markets, and that entire 400-point rally in the Dow disappeared, and the Dow went negative. And the words that he spoke that spooked the market were that price stability is essential, and the historic record cautions strongly against prematurely loosening policy, and that we will stay the course until the job is done. Now, this Powell reiterated the Fed's commitment for positive real interest rates, meaning an interest rate that was higher than the inflation rate. Powell basically said, yeah, that's where we're going. And right now, the Fed funds rate is 4%, and the inflation rate is higher than 8%. Now, Powell implied that he believed that we would get to positive real interest rates because of a reduction in the inflation rate. So it wouldn't require interest rates above 8%. If inflation came back down to 4%, well, we could have positive real interest rates at 5%. But what the markets are likely to be afraid of, and if they're not afraid of it now, they will be, is what if inflation doesn't come down? What if it stays high? What if maybe it comes down, but it only comes down to 6%? Well, that means if Powell wants to have positive real interest rates, if inflation is 6%, then we need to go to 7%. And that's a much higher rate of interest than the markets are prepared for or could handle. And so I think the fact that Powell had to acknowledge that ultimately we have to have a positive real interest rate, that is very scary for the markets. Then Powell was asked a question about what he and the FOMC believed was the current underlying inflation rate in the U.S. economy, meaning not the headline rate that we all read about, but beneath the surface, what do you think the rate really is? Because it can't be 8.5 or whatever the CPI is. It must be something lower than that. And so what do you think it is? And Powell's answer was, we don't have a number. Like, we've got no idea. We're clueless as to what the underlying rate of inflation may be. Now, that is a very scary admission by the Fed, because if the Fed is committed to fighting inflation, but it doesn't even know how big the monster that it has to slay is, then how does it know how many rate hikes are going to be necessary? How does he know how high rates have to be in order for there to be a positive real rate of interest if he doesn't even understand what the underlying rate of inflation is? And if he doesn't understand it now, why will he understand it at some point in the future? The Fed has no clue. All it's looking at is the same headline numbers as everybody else. And based on that, the Fed is still way behind the inflation curve and has a long way to go. And that, again, should scare anybody who is counting on the Fed to ease up on its current. In fact, what Powell said eventually was that the Fed has no way of knowing when inflation becomes entrenched. That's another scary admission by the Fed, because if it doesn't know, it's just kind of flying blind, and it has to err on the side of caution to make sure that consumers and businesses aren't causing inflation. Businesses don't cause inflation by raising prices. Workers aren't causing inflation by demanding raises. Workers need raises because of inflation. Companies are raising prices because of inflation. It's got nothing to do with psychology, and it's got everything to do with fiscal and monetary policy. Then, in response to another question, Powell was very forthright in his admission that inflation was a lot higher and had lasted a lot longer than the Fed had anticipated. So again, this is tantamount to saying we got it wrong, we made a mistake, and now we need to correct that mistake by staying tighter for longer or going higher than the markets expect. In fact, Powell reiterated something that he had said in the past, that the risk is doing too little on tightening and not doing too much. Powell further stated that he would prefer to over-tighten rather than under-tighten, because if the Fed tightened too much, according to Powell, the Fed has the tools to support economic activity if necessary. But if we don't tighten enough and inflation gets out of control, well, then it will become entrenched, and then it will be too late. And so the Fed is going to err on being too tight. Again, Those are very scary comments, especially if you are expecting the Fed to adopt a softer tone. And by the way, Powell is wrong to think that if they just tighten too much, meaning they tighten so much that the economy really weakens into a severe recession, that the Fed has the tools to prop it back up and stimulate it to support economic activity. It doesn't. Because if the fight against inflation drives the economy into recession, if the Fed then uses those very tools to support the economy, well, then inflation is going to take off and get much worse. You see, if the Fed is really committed to fighting inflation, then those tools are no longer at its disposal. The fact that Powell is so quick to admit that he's going to use those tools if the inflation fight does too much damage to the economy really reveals that the Fed is not as committed to fighting inflation as it maintains or as the markets believe. Because as I've said many times, the Fed's commitment to fighting inflation stops if it brings about a severe recession or a financial crisis. Yes, the Fed is willing to tolerate a very mild, shallow recession, but anything greater than that, and the Fed is going to use its tools. And in fact, I think that it's going to use those tools long before inflation gets anywhere near 2%. But even in the extremely unlikely situation where the Fed got inflation back down to 2% because of its tightening, and then with inflation at 2%, the Fed then used those tools to stimulate the economy, anything it had achieved in reducing inflation will be lost, and the inflation rate will spike back up again. So even if inflation does go to 2%, the Fed still can't use those tools. But I have never heard Powell acknowledge that if the economy goes into a severe recession or a financial crisis, that it's not going to matter, because the Fed is going to continue to tighten and maintain tight monetary policy to make sure inflation not only goes down to 2%, but stays at 2%, no come out of the Fed. Powell talked about how we still have a long way to go. We still have lots of ground to cover before we get interest rates up to restrictive territory, meaning that even though we're at 4%, rates are still not restrictive. And of course, they're not. That's been my point the entire time. You don't have restrictive interest rates until the interest rate is above the inflation rate. As long as you have an interest rate that's substantially below the inflation rate, you have an accommodative monetary policy. You are creating, not restraining inflation, and that's exactly what's going on. Consumers are not saving. In fact, they're depleting their savings. They continue to spend. They continue to borrow and spend. And so does the government. The deficits are getting bigger. They're not getting smaller. Sure, Biden takes credit for an initial decline in the deficits because we stopped all the COVID-related stimulus spending, but the deficits are now on an upward trajectory, and this is highly inflationary. But Powell admitted that the Fed has no sense that inflation is coming down. And he said that we are exactly where we were a year ago. Think about that. The Fed admitted to having made no progress in a year. A lot less probable, because he said the window to a soft landing had narrowed. And then the reporter who asked the question followed up and wanted to know, well, why did it narrow? And Powell again was honest in that he said that the reason that the window to a soft landing had narrowed is that the Fed has been disappointed that inflation has not come down the way he has hoped. Now, of course, inflation hasn't come down because we haven't had the policies to bring it down. And the main reason it hasn't come down is because the inflation that we're fighting was created a decade ago. When you talk about lags, that's the lag. We have been flooding the pipeline with inflation for more than a decade. And now we're just seeing the tip of this enormous iceberg. Nothing the Fed has done so far is sufficient to put this genie back in the bottle. But Powell admitted that the inflation picture has become more challenging over the course of the year. And as a result, policy needs to be even more restrictive. And Powell said that it's the more restrictive monetary policy that the Fed has to pursue because it has been surprised by the resilience of inflation. That's the reason that the window to a soft landing has narrowed. And we could have significant more weakness in the stock market, which is not going to bode well for the Democrats, because all this is going to be blamed on the incumbents. The voters are going to want to throw the bums out, and the only bums they can throw out are the Democrats, because the Democrats control the White House and both houses of Congress. Now, there's no way to throw out Biden because he's still there for another 2 years, but they can throw out the Democratic majority in both the House and the Senate, in which case we will have divided government. But what we won't have is an effective way to rein in inflation, because for all their tough talk about their opposition to the Biden spending, a Republican Congress is not going to cut spending either. They didn't do it when Trump was president. They sure as hell aren't going to do it when Biden is president, and Biden wouldn't even sign it. What the Republicans are going to do is potentially deliver tax cuts to accompany Biden's spending increases to throw more gasoline on this inflation fire, and that's going to be an even bigger headwind in the inflation fight than the